Good evening and welcome. It's really nice to see so many people here today. We are here from all over the world to discuss a very important topic, capitalism and the future of humanity. I think it's not only me that have had this feeling that capitalism, it's probably not the optimal system. It has some very serious flaws. So during the last decades, capitalism has been responsible for a huge economical, ecological, and social crisis. Capitalism is not working anymore. Urgent change is needed. However, to be able to change a system, you need to understand it. To fix capitalism and build a brighter future for us all, we need to understand exactly what is wrong with capitalism. To help us with this topic, we have invited Jonathan McMillan this evening. This name is a pseudonym for two persons. So we have Jürg Müller. He has a PhD in economics and is the director of Avenir Suisse, one of the largest think tanks in Switzerland. Then we have the banker. He works for a large international bank and can, due to his position, not announce himself publicly. However, we're very honored to have you here at this webinar today. So together, these authors, they have so far written two books. So the first book was a great success. It has been praised by large international newspaper and professors in economics all over the world. It was a really concise, analytical, and well-written masterpiece, I would say. As Professor Hockett formulates it, it's easily the deepest examination of our financial system in a generation. In their new book, Capitalism and the Market Economy, the authors dissect capitalism down to its barest elements and explain in a convincing way what is really wrong with capitalism. So in short, the core problem is state-backed money creation by corporate banks. Moreover, they provide a realistic and thought-provoking plan for how a stable transition to a better system can be made. So before I give the word to you, I will just say something about who are organizing this event this evening. So we are organizations from IMMR, the International Movement for Monetary Reform, and we exist in 29 countries. We work for a more democratic, sustainable, and fair monetary system. And my name is Samuel, and I'm from the Swedish branch, Positiva Pengar. This webinar, it's a cooperation between some of us, and you can see which organizations here to the right of the picture. We're also sponsored by the Financial Ethics Group of Göteborg University that are helping us with their Zoom account to be able to meet this many people at the same time. So the agenda for this evening, short introduction by me, then we'll have your presentation, and then I will have a short interview for like 50 minutes. Then it's time for questions from the audience. And then at 8:30 p.m., the webinar, it will formally end then. But the questions and answers session will continue with more in-depth questions, more advanced questions and discussion for 30 more minutes. So the idea behind this is that everyone here is probably not financial experts and nerds. So we will take the questions that's possible to understand for everyone first, and then we can continue with more advanced questions in the end of the webinar. Very welcome, Jonathan McMillan.
Thanks a lot, Samuel. Thanks for the introduction, and thanks everyone for taking the time tonight to listen to this presentation. I'm really glad so many people came. So I hope you can see the screen and you can hear me well. And we'll talk about some quite big topics tonight, the really big concepts within our society and economy, capitalism and the market economy. So I want to start, let me go on full screen. I want to start with a chart that will kind of come back in this presentation over and over again. It's kind of one of the big topics that is related to capitalism. And it's kind of also, let's say, the big success story that capitalism tells about itself. So we have the GDP per capita in England, which we can use as a proxy for the economic development and the increase in productivity over time. And we see it over the past almost 800 years over this graph. And we see basically flatlining until somewhere around the middle of the 17th century. And then it kind of changes and it turns into this hockey stick curve that we see today. And it's one of the big narratives of our society that basically this is what capitalism has achieved. In the middle of the 17th century, we adopted this modern economic system. And thanks to this modern economic system, we saw an explosion in prosperity. Now, when we look up the definition of capitalism, and yeah, you can go to any kind of encyclopedia or web dictionary, you'll always find two concepts that are central to the definition of capitalism. It's about private property rights and it's about free market economy. In a nutshell, capitalism is a free market economy. We somehow adapted it in the middle of the 17th or beginning of the 18th century, and we saw this explosion in prosperity. It's a really nice story. It's just wrong. It has to be wrong. And it's actually wrong for a very obvious reason. We define capitalism on two levels, on a historical level and on a conceptual level. On a historical level, we say modern capitalism has started to exist somewhere around this time frame between the middle of the 17th century and the beginning of the 18th century and started off in England. But conceptually, we say it's because we adopted private property rights and market economy. Private property rights have already been firmly embedded in Roman law, and they predate this historical period that we call capitalism for centuries. Already Plato is talking about the market economy and what kind of advantages it can give for the division of labor. So the market economy itself is also thousands of years old. And in this time frame where we historically think capitalism has started, we haven't really seen any kind of major fundamental changes to these two concepts of property rights and the market economy. So one of them must be wrong. Either the historical definition of capitalism is wrong or the conceptual definition of capitalism is wrong. Both of them cannot be true. And I think, and my co-author thinks, that the historical notion of capitalism makes sense. And it makes sense because the story, what the graph tells us, is correct. We saw a change in prosperity, and there must have been a change in the economic system that happened at the time. But conceptually, it wasn't about property rights and it wasn't about the market economy. It wasn't this change that we saw around that time. So this is how we set the stage. And I would like to take you along in a journey looking at the history of capitalism and in that way really get a much better understanding conceptually what capitalism is really about and also why we see all those flaws and weaknesses today and how it will evolve in the 21st century. But before we get there, we have to start at the beginning of the 17th century, and we start in England because this is the place and the time where this journey of modern capitalism starts. And journey is a nice word because what you see here is the world map. And we're in the beginning of the 17th century. And England just had a major war with Spain. They defeated the Spanish Armada. And for England, this meant for the first time in their history, the entire world opened up for trade. And there was one trade route that was particularly lucrative at the time. And you see it drawn here. It was the East Asia trade. So if you can charter a ship or many ships from Western Europe, make your journey around the Cape of Good Hope, and then buy the spices in Indonesia and other Asian countries, and then bring it back to England or other Western countries. If you succeed in this trade, you will make a fortune. Now imagine you're one of the richest individuals in England at that time. If you want to engage in this business, you have to charter at least 2 or 3 ships. You have to fill them with silver, and then you have to do the whole journey around the Cape of Good Hope to buy the spices and then make it back. Now, even if you're really the richest man or woman at that time, it's likely will take your entire financial resources or even more than that to charter such a voyage, to buy the ships and to acquire the silver. Even if you're able to do so, the risks of this business are extreme. I mean, you can get into storms. The Dutch and Portuguese ships will try to seize your cargo, or you could have sickness by the crew, so they cannot continue the journey. So there's a very high likelihood that you will not succeed and you will not come back with the spices. And if that happens, then you're financially ruined. But some clever businessmen and women, they had an idea. Let's charter a corporation. So they went to the Queen of England, to Queen Elizabeth, and they asked her for a royal charter to create a corporation, which became a legal entity in its own right. And with this charter of incorporation, those businessmen and women, they could walk around London, knock on all the doors of the rich people, and ask that they participate as passive investors in those endeavor. And then they would hire a crew, a captain, a management to administrate and to conduct the entire journey. There were also other corporations that were founded at the time, but this corporation with this business idea that was called the East India Trading Company was one of the earliest companies and became one of the biggest and most famous and infamous corporations that the world has ever seen. And this corporation achieved a vital thing that would not have been possible for a family or a private business. It could really attract funding from a lot of different passive investors that did not necessarily know each other. And because a corporation also offered limited liability to the investors, to the shareholders, this corporation could also take on much higher risks than a family or private business would ever been able to do. And this led to the possibility to have a capital intensive and very risk friendly corporation to be set up. And it's no surprise that the sea trade was like the first application of this new corporate form that really kind of came into being at the beginning of the 17th century. When we talk about other corporate endeavors that were for which the corporate form was really important, we talk about big factories, about big infrastructure investments, and later on the railroads, everywhere where you had to pool resources and financial might from hundreds or thousands of different investors, the corporation was the vehicle to go. And historically, the rise of the corporation almost perfectly coincides with the historical period that we today denote as capitalism. So for us, it's not market economy or private property rights that really defines this historical period that we call capitalism. It's really the corporate form. So I want you kind of to keep this thought in mind. Capitalism is about corporations. It's not about markets and it's not about private property rights. But this is only one part of the story. And we have to add in more concepts so to really understand what so fundamentally changed our economic order around the 17th and 18th century. And the second concept I want to talk about is the concept of banking. I think many of you have heard about the concept of banking, I mean, in a more academic sense, but I really want to make it as clear and as precise as I can do. And I also want to stay in the story of capitalism, because when you go back in the time where banking was used in its earlier forms, it really helps a lot to understand why this business was conducted as such, and what kind of the consideration and rationale was of the bankers and the customers of those banking institutions. So now let's imagine we're still in England, we're still in the 17th century, we're in some smaller city in England, and let's assume we are merchants and we're buying those spices from the East India Trading Company, and then we're selling them to end customers. And also let us assume we have been doing this for quite a couple of years, and we had been successful. So we kind of accumulated a small fortune. Now, when you accumulated a fortune in the 17th century, that means you acquired gold and silver coins, because back then money was gold, was silver, was precious metals. But that is kind of a problem, because imagine living in this city. If you store these gold and silver coins at home and they get stolen, they are lost and you will not get them back. So you need to safeguard those silver and gold coins. And it would be really expensive to hire your own security or build your own vault. So what people did at the time, there were always like local goldsmiths in the cities, and you would go to such a local goldsmith and you would deposit your gold and silver coins with these goldsmiths. Let's assume that we would also do it that way, because we don't want our gold and silver coins to be stolen. And the goldsmith would issue a receipt to us, confirming that we have deposited the money. And the goldsmith tell us if we would hand him the receipt back, he would then pay us or give us the gold back again. So far, so good, so simple. Let us now assume that the merchant of the East India Trading Company or a middleman arrives with new spices and wants us to sell those spices that we then will sell on to our own customers. So we decide to buy those spices. And now to pay the merchant, we could go back to the goldsmith. We could hand the receipt to the goldsmith. The goldsmith would give us the silver coins and the gold coins. We would go back to the merchant of the East India Trading Company, and then we would hand the gold and silver coins to him. That's perfectly feasible, but it's very cumbersome. And we also learned that this merchant also has a safekeeping deposit with the same goldsmith in town. So he just should suggest us, hey, why don't you just hand me over the receipt? Much easier. That way we can save both ourselves the hassle of going to the goldsmith and back, and we can conclude the transaction right here, right now. And now we see already a core function of banking at work here. We see here that this goldsmith virtualized those gold and silver coins. Even before Bitcoin and other cryptocurrencies, the virtualization of money was one of the key financial services that were developed. And with that, this goldsmith can offer payment services. But this is only half of the story, and it's the less important half of the story. So I want you to take this example, or to come with me along one more step in this example. So we have conducted a trade with the East India Trading Company. We have all the spices, but we don't really have a lot of money left because we haven't sold our spices yet to our end customers. We're not really liquid at the moment. Let us assume now another merchant comes, and this merchant is from the Hudson Bay Company. And the Hudson Bay Company just had a colony established in North America, and he has a lot of furs to offer. And you as a merchant know those furs, your customers would really pay a lot of money for them, for those furs, and you're absolutely convinced that if you can get your hands around those furs, you will sell them on and you will make a big profit. But your problem is you don't have any gold and silver coins. You just have your spices. So at this point in time, you have two options. You could either say, well, bad luck. Let's hope the merchant of the Hudson Bay Company comes another day and then you can seize on the opportunity. Or you go to your goldsmith and ask him whether he has some money for you. Let's assume that we do that and we tell the whole story to the goldsmith, and the goldsmith knows us for a long time. So he knows that we have a lot of customers, and he firmly believes that we will be able to sell those furs within a reasonable amount of time. And then we will be able to repay the money if we borrow it today. So the goldsmith agrees, yeah, let's do that. I will give you a loan. And now it's not like that the goldsmith will now walk down to the vault and then get the silver and gold coins out of his vault and then count it and then hand over a bag of gold and silver coins over to you. No, the goldsmith will simply write an additional receipt to you and hand it over. And then, just as you did it with the merchant of the East India Trading Company, you can hand over this receipt to the other merchant and buy the furs, and then hopefully sell your furs and repay the loan later on. And this is the essence of banking. When the goldsmith issued the receipt, he created this money, this new money out of the loan he made to you. He didn't have the gold and silver coins in his vault to issue the receipt. Suddenly there were more receipts outstanding and in circulation than there was gold and silver coins in the vault. So banking is really about the creation of money out of credit. And this quite accurate historical example on how banking was conducted in the middle of the 17th century also shows what kind of huge potential and huge risk this banking business originates. On the one side, without a doubt, this loan that the goldsmith made stimulated economic activity because we were able to buy the furs and we sold it out to customers. All of this would not have happened if the goldsmith didn't create the money out of credit. But on the other side, we also see that there is more paper money, more receipts, we would nowadays call them banknotes, outstanding, than there are actual reserves in the vault of the goldsmith. And so in case too many depositors would come to the goldsmith and ask for conversion of those receipts back into gold and silver coins, then there is a probability that the goldsmith would not be able to honor those requests and that he would go bankrupt, and then also his customers would face heavy losses. And we will come back to both of these impacts of banking very soon. So we already covered a lot of ground. We talked about corporations and why they came into being. We have talked about banking and we learned really what is the core of banking? How does banking work? And now I think we come to the point which I consider probably the most important point in time to understand this modern economic order that we live in today. And I think it's a date and an event that is vastly underappreciated for the importance it has for today's economic order. And for this, I want to take us towards the end of the 17th century to the year 1694. In the year 1694, something happened that changed the, the economic order fundamentally, and it has changed it to this day. 1694 was the year in which the Bank of England was chartered. Now, why is it so significant, this event? Well, for the first time, really, we see how the concept of the corporation merges together with the concept of banking. And we know that the banking concept is about creating money out of credit. What we have seen in our example, those goldsmiths, they were very restrained in their business. They had to have very local ties. They had to be extremely careful in their money creation activity as they were fully liable with their own private wealth. So they weren't really able to achieve like any large scale. So before the Bank of England, almost all of the money was still just silver and gold coins. But the Bank of England was also a corporation. So the Bank of England could source capital from thousands of wealthy Londoners who invested into this new corporation. And it also got the backing of the state. The King of England, King William III, had his war against France going, and he was desperately in search for additional funding sources. So his motivation was that the Bank of England would help him and give him, grant him loans and help him finance his war against France. So the Bank of England added this capital intensity and this risk appetite into the banking business. And it created much more money and credit than whatever was ever possible before this merge of those two concepts. And to really understand the significance at that time, gold and silver coins, they were really scarce. This scarcity was a drag on economic development. And this drag motivated a lot of people to pursue alchemy, to try to transform base metals like lead into gold and silver. A lot of noble people invested sizable amounts to kind of foster this type of science. But in the end, it was legal alchemy that did the trick. And with the establishment, the chartering of the Bank of England, the traditional alchemy came completely out of fashion and disappeared. So the powerful side of the banking business is money creation, and then put on steroids by the new corporate form was quickly seen. Both the government, but also the commercial sector benefited from this flood of money. But there was also something else happening because this whole money creation became so big. It wasn't longer a microeconomic thing. It started to affect the entire financial system, the entire economic system as a whole. And again, the story lines really nicely up. So we can really go forward and look at the historical events that took place after the Bank of England was chartered and incorporated. It only took 2 years for the first bank run to happen. Less than 30 years later, the world has seen the biggest asset bubble and bust to this date. In France, it is known as the Mississippi bubble, and in England, it became famous as the South Sea bubble. And it's really important to understand how corporate banking has an impact on the entire economic order. And for this, we need to discuss the boom-bust cycle that corporate banking triggers. So as I said, when corporate banking comes into being and starts operating, it creates such large amounts of money and credit that it affects the entire financial system. You have a large increase in the supply of money. And this supply of money is invested into financial markets. Those are markets for assets like real estate, like shares of corporations and other assets. And if you have more money chasing the same amount of assets, then the prices of those assets must go up. But if those assets, the houses, the share price, if they increase in value and in price, then this affects banking again, because banking would extend loans and create credit backed on collateral. So they would take in collateral and securities like real estate, like mortgages, like shares for Lombard loans to make their lending. And that means when those assets increase in price, then banks can lend more money against those assets because the collateral is worth more. But if they lend more money, they also create new money because that's what banking is. Banking creates money out of credit. And this additional money then again would impact financial markets and drive asset prices up even further. And now we see there is a circle at place. Increasing asset prices expands lending, expands the money supply, expands or increases asset prices even further. Yeah, 1720 was the first time we saw this cycle going through several iterations and pumping up the prices of those new trading companies like the Mississippi Trading Company or the South Sea Company to stratospheric levels the world had never seen before. The problem just is this cycle cannot continue forever. Because at some point, when a borrower again has a decision, should she borrow more money against the assets that have already increased again in price? At some point, she will conclude, no, if I borrow even more money, even if asset price would rise further, the interest I have to pay on this loan is not worth it to kind of benefit from further asset price increases. So instead, then, this first borrower will decide to instead sell her assets and repay the loan. And others will follow. But if many people sell assets, then this will put downward pressure of the prices of these assets. And if the prices of these assets decrease, then what we will see is that banks will start to worry about how much lending they have outstanding because the collateral that they have against their loans will decrease in value as well. So they will ask their borrowers to repay the loans and to liquidate their assets to repay the loans. And that means further borrowers will liquidate and sell assets, further putting downward pressure on the prices. And again, we're in a circle again, in a cycle, but it goes the other way now. We have a decrease in asset prices that constrains lending ability of banks and that further motivates asset selling by borrowers, and the cycle is closed. And we call this the bust phase. So this boom that we've seen before will turn into a bust, as also happened in 1720 when the price increased by 20 times of those famous shares. But at some point, depositors of those banks, they will notice that something is foul. They will see that banks struggle to get their loans repaid. They will see that banks suffer losses on the loans because their collateral is no longer worth as much. And so those depositors will get nervous as well. And they will say, let's go to the bank. Let's bring the banknotes back. Let's get the silver and gold coins out to make sure that when the bank goes down, my money is no longer on the line. And this is then when the bust turns into a financial crisis. And as you can see, we had the Bank of England chartered in 1694, 2 years for the first bank run to happen. And then during the course of the 18th century. We see already 1720, 1763, and 1772 such episodes where we had a boom that turned into a bust and a financial crisis where we had bank runs and bank panics and bank failures. There was a lot of history now. And now I think we should zoom out again and really think about the conceptual implications. We talked about capitalism. And I would really offer another definition for capitalism that makes much more sense because it allows us much better to understand how our economic order actually works. Capitalism is an economic order in which most of the capital is managed by corporations. And it's not only about corporations like the East India Trading Company, it is particularly about corporate banking. And capitalism, its purpose is really to have this capital intensity. The corporations themselves that pool together wealth and resources from hundreds or thousands of investors. Corporate banks who create money out of credit, the fuel to build factories and infrastructure and railroads and all those very capital intensive businesses. And that does not mean that the market economy does not exist. Of course it exists. It's much older than capitalism, but it's a different concept. It has to be distinguished from capitalism. The market economy is about the market. It's about the free exchange of goods and services and contractual claims. And the market economy is about property rights and about, as I said, the markets. And it's really that the purpose and the benefit it brings to our economic order is it that it allows the division of labor, competition, and innovation. So when you recall this prosperity hockey stick, that very first slide we looked at and which we will come back to, it's an addition. Basically, the story should go like this. We had a market economy for thousands of years. Then we brought in corporations, we brought in corporate banking. The entire economic system changed, and it seemed that this has led to prosperity. And this is an important differentiation to what basically the traditional story is that just focuses on markets, property rights, and the profit maximization. And I want now to go back to our timeline. We're now towards the end of the 18th century, and you see the face of a very famous economist that basically was one of the originators of this wrong narrative that it's all about the market economy. What you see here is the picture of Adam Smith. And Adam Smith really published his basically big work, which is aptly titled The Wealth of Nations. So he also really thought about prosperity in 1776. And it's interesting because we know, or he's world famous for what he wrote about the market economy. But he didn't only wrote about the market economy, he also wrote a lot about corporations and about corporate banking. So he also wrote about capitalism. And when we take our definition, this more meaningful definition that capitalism is about corporations, then it is fair to say that Adam Smith was the first, and he was a vocal anti-capitalist. He hated corporations. He couldn't stand them. And it's quite clear why he couldn't stand them, because the East India Trading Company was not only a corporation, it also got this monopoly privilege. All the trade around the Cape of Good Hope was monopolized by the East India Trading Company, and that was sanctioned by the Queen and the King. And of course, for Adam Smith, such a fervent supporter for markets, he would detest monopolies like that. And the East India Trading Company was also, they even had an army. They were like a para-governmental institution that waged wars in colonies and colonized countries. And for Adam Smith, he was a pacifist because he also said, like, prosperity is destroyed by wars. So there's a second reason why Adam Smith didn't like corporation. But he even had a more fundamental reason. He thought this separation of ownership and control cannot work. In his mind, if a family business or a private business that have their whole skin in the game would compete against corporations, then they would always win against those uninvested managers who don't care whether the business succeeds or fails in the end. Yeah, Adam Smith was completely wrong about that. The corporations took the world by storm and they dominated today. And the reason is that this capability of corporations to enable capital intensive economic activity far outweighed those disadvantages of this, we would call it in economics, a principal agent problem. But now it gets even more interesting because he also wrote about corporate banking. And I think there he was much more on point than when it's about corporations in the real economy. He was a huge fan of the Bank of England. He hailed it as the great engine of the state, and he was a big supporter. And at first that seems a bit odd. So why would he detest corporations in general, but love the Bank of England? Because the Bank of England would stand for everything that Smith is against. It had a monopoly at some time for the issuance of money. It was used by the king to finance wars. And it was a corporation like the other corporations. But for Adam Smith, it was clear that when we talk about the relationship between capitalism and the market economy, that they are two very different things. And I think what Adam Smith saw is that corporate banking has nothing to do with the market economy. Corporate banking operates outside of the market economy. Corporate banking needs to be regulated and controlled by the government at all times, because otherwise the rest of the market economy and the rest of the economic order cannot work. And this view from Adam Smith basically was implemented and taken with us to this date. So what Adam Smith formulated first about his treatment of corporate banking, to take it out of the market economy, to regulate it, and to guarantee it, has become the absolute dominant policy position for the next 200 years all around the world. And that's why I want to quickly phase out of the history again. And don't worry, we will get faster along the way, so it's not taking another 2 hours. But this is important. So let's think about our economic order as a donut or two circles. We have the real economy, that's the big circle. And at the core of our economic order, we have the financial system. Now let's add capitalism to the mix. Capitalism is everywhere. The entire real economy is organized and dominated by corporations, and so is the financial system. The Bank of England itself is a corporation. It somehow turned into a central bank over the centuries. And now let's add the market economy. So we have now the color. Blue means this is a space where the market economy principles apply. And red, this is a space where the principles of the market economy cannot apply. And this is the story of capitalism. We had a market economy, then we want to add capital intensity. So we added those corporations and bank corporations. But that means our economic order has to give up at its core the ambition to be a market economy. Those bank corporations cannot operate according to the principles of the market economy. So what are the principles instead? Again, you could have a 3, 4, 5 hour presentation about that, but let's just stick to the basic elements here. We talk about guarantees and constraints. It's a carrot and stick approach. On the one side, we have guarantees, and this is when the bus turns into a financial crisis. We want to have measures that prevent depositors from panicking. So depositors and people doing business with the banks should always be assured that the banks can never fail. For that, we implemented first central banking, then we added deposit insurance, and in the last decades, we enforced the too big to fail doctrine, where we say every liability from every bank corporation is guaranteed at all times. Of course, only having guarantees would be a bit lopsided. So because we remove the market forces from, let's say, the side of the stakeholders on the liability side, we also have to do it on the asset side or on the other side. So we have to make restrictions on their business. We have to implement capital and liquidity requirements. Those are measures that all these measures prevent that bank corporations create excessive amounts of money and fuel unsustainable asset price booms. So when you think about back, we talked about this asset boom that turns into a bust and then a financial crisis. This framework should ensure that on the one side, the boom will not get out of control, and on the other side, that the financial crisis would not inflict too much damage. So how did it go? Let's look at the next 150 years. Every time you see a red annual number down here, that has been a financial crisis that was preceded by a boom and then turned into a bust. We have no control about this asset boom busts, and we never had. And history is very, very clear on that these asset booms, bust, and the financial crisis that follows are an inherent part of the capitalist economic order. And capitalism is really a story about manias, panics, and crashes. And I want now to quickly go back to the very first slide before we continue, because, and this is a central argument about the economic order. I mean, we left this naive space saying, oh, it's about the market economy, blah, blah, blah. That's really not a helpful way of thinking about it. But now we're on a place where we can better understand, let's say, the capitalist argument. And the genuine capitalist argument should rather be, yes, we have crises all the time, but look at the overall long-term trajectory. In the long run, we're all better off. So this is just the price we have to pay for prosperity. So we will always have those boom and busts and crises, and that means we will have those hiccups along the way. But because this system is so great, so magical at generating prosperity, we should accept it. And that's the price we have to pay. And now we come to the central piece of the argument. This capitalist argument may have been right until the beginning of the 20th century. But I am convinced it is no longer correct. I'm convinced this prosperity trajectory that we've seen over the past 300 years will not continue like that. We will either stagnate or fall down because our economic order is falling apart. And this has to do with the fact that the times have changed, that society has changed, and that the technology has changed. And for this, we go to the second half of the 20th century. And I think this fundamental change happened in the 1970s. And I accumulated some graphs that kind of show that really things that were quite stable over 200 or 250 years suddenly started to detach. So we see asset prices as proxied by the real house price in Amsterdam. It's nice they have like really long times back with and it's very interesting that the house price moved in a very, very narrow range historically over more than 300 years. And in the 70s, they suddenly explode. Asset prices, one story. Consumer prices, it's the same story. Again, it's very interesting that for almost 150, 160 years, we see almost stable prices. But then in the 70s, we see consumer prices exploding. And it's not only price stability, also financial stability. And it's really interesting to see this overall trajectory. I mean, this is the number of countries with banking crisis. So it could also be a bit, there were more and more countries that had banking systems. And we had, after the Great Depression, we had the biggest boom in, let's say, constraints and guarantees being implemented. And it seemed to work for some time remarkably well. But since the 70s, we see an absolute explosion in financial instability. And we see that on many metrics. We see that on metrics like bank failures, on asset price volatility, on the boom bust cycle. It has been really going out of control since the 1970s. And it's another chart. This is not log scale. This is like real numbers. And it kind of shows you the financialization of the entire economy as proxied by the US government debt, I think on a federal level. And this is just, yeah, very impressive, this exponential explosion of assets, of debt, of financialization. And also here, we see a secular change in trend since the 1970s. So we think there are two things that happen. One is really this complete detachment from gold and silver into a fiat monetary system that basically removed any limitations given and allowed basically the financialization to take up speed. But even more important, it was the digital revolution that started in the 1970s in the financial industry. And you have to imagine before the 1970s, banking was a pen and paper business. Every transaction, every loan, every payment had to be recorded on a physical book. And that really contained corporate banking in a very simple business model that was more or less only pursued by traditional banks. But the digital revolution mobilized credit and money. Now, with a click, you could move money and credit across balance sheets, across jurisdictions. And you found new ways of corporate banking that was taking place outside of traditional banks. We later called this the shadow banking system. And the shadow banking system was able to basically avoid all those constraints that were implemented on the traditional banks, but in the end succeeded to enjoy all the guarantees that were also preliminarily thought to be only reserved for the traditional banks. And I think those two effects change the entire picture of our economic order. On the one side, what we see is that the financial system gets bloated. It gets bigger and bigger, and we see this inner red circle growing. And with this growing, also the market economy becomes less and less prominent, right? Because within the financial system, market principles cannot apply. But there's even a bigger problem that is triggered by the shadow banking, by this fact that this creation of money out of credit has been detached from the traditional bank balance sheet and has spread into the entire system. There is no longer this traditional separation between the financial system and the real economy. We see financial money creation and systemic risk-taking spreading in the entire corporate world. And that means also in the real economy, the market economy gets eventually squeezed out. Everything has to be subjected to the overarching dominance of the financial stability argument. And what that means is if we continue in the same economic order as we have established it with the Bank of England in 1694, we will have a pure capitalist system and the market economy will be completely squeezed out of our economic order. And I believe Adam Smith was right. I believe that the market economy is a very important ingredient to the prosperity. Without genuine competition and innovation, there will be no further increases in prosperity and more likely even a gradual degradation of all that we have achieved over the past 300 years. And even worse, I think, and even more important to mention is the fact that the market economy is one of the pillars of an open society, as is democracy or the rule of law. But if the market economy falls into disgrace, and if people acting in their own interest lead to financial crisis and booms and busts, then perhaps the concept of freedom itself can no longer be justified on material grounds. And I think we all see that those capitalist systems at the beginning of the 21st centuries begin to converge into this capitalist non-market economic order. And it's interesting to see like the United States starting from a very market economy order and China starting from a socialist order, both converging toward this pure corporate capitalist system. So urgent change is needed to prevent this nightmare scenario from unfolding completely. And this fate is not inevitable because capitalism is about corporations. Corporation is about law. It's a legal construct. It has nothing to do with some kind of natural trajectory or unavoidable natural catastrophe. It has been created by humans and it can be changed by humans. And how can we do that? The principle is quite simple. We need to find the line where capitalism can be aligned with the market economy, where capitalism is compatible with the market economy, and differentiate it from the capitalism that is not compatible with the market economy. And we have developed a rule that can do that, and we call it the systemic solvency rule. I don't want to go into too much detail because there's a lot of technical balance sheet stuff to weed through. And we have explained it in very great detail in our book. And I can also answer some questions later on. But think about it that every corporation is a domino stone. And when a domino stone falls, that means that this corporation is going bankrupt or insolvent. And the systemic solvency rule now prescribes a minimum distance between all those domino stones. So if one corporation falls, it will not cause or trigger the failure of another corporation. And this way, we no longer have financial chain reactions between corporations that are systemically solvent. And systemically solvent corporations are compatible with the market economy. They can be aligned with the market economy. And systemically insolvent corporations, they cannot be aligned with the market economy. Those are corporations like banks, but also shadow banks, hedge funds, other kind of investment banks or financial institution engaged in the creation of money out of credit. Those are systemically insolvent corporations. So we will use this rule to redraw the boundaries between the capitalism that is aligned with the market economy and the capitalism that cannot be aligned with the market economy. And every corporation that is not systemically insolvent will fall into this red circle. And then as a next step, we say, well, for systemically insolvent corporation, we have an experience of 300 years of dealing with asset booms, busts, and financial crises. We always bailed them out. So now we will do this explicitly. We will guarantee all the liabilities of all systemically insolvent corporations. We stop this charade of pretending that in the next financial crisis we will handle things differently, because we will not. We haven't done it a single time in the past 300 years. So let's do this explicitly. Let's guarantee all the liability of those systemically insolvent corporations. But then on the flip side, we implement effective constraints. We implement capital requirements that are 20, 30, 40%. We implement liquidity requirements that are really stringent. And we also try to establish resolution regimes that finally work. And this way, we will do everything we can to prevent those systemically insolvent corporations to abuse these guarantees and to keep them under control, because they are not allowed to act like like corporations in the market economy. They are not part of the market economy. So they should be very, very densely regulated so that they cannot abuse their guarantees in any way or form. And this way we can at least restore our economic order to the same like functional effectiveness that we had, let's say, before the Great Depression or before the 1970s. But we can do more than that. I firmly believe that a systemically solvent financial system is possible. And it's again technology that plays an important role in making this possible. We have new financial concepts like peer-to-peer lending. We have cryptocurrencies. We have blockchain. And all these new financial techniques will allow us to offer and to conduct financial services in a decentralized, in a transparent, and in a systemically solvent way. So as a next step, we really need to make sure that there is a level playing field between the systemically insolvent financial corporations and the systemically solvent financial corporations. And that means we need to adequately charge those systemically insolvent corporations on the one side for the guarantees, for the generous guarantees that society is granting them. They should be taxed, they should pay for it. And on the other side, also, they should pay for the entire regulatory framework we have to put up to prevent that they are taking down our economic order. It's like a pollution tax. They should pay for all the external effects they impose on the economic order. And I'm convinced that this will happen. We will squeeze out this systemically insolvent financial sector, and it will eventually disappear. The same will happen in so many other industries where the technological disruption led to completely new business models taking over. And this will be an economic order that no longer relies on money creation out of credit, but that uses modern technology to coordinate and allocate the resources in the real economy. It will no longer be this boom, bust, and financial crisis economic order, but it will be one where the market economy, the principle of the market economy will also apply at its heart, at its core in the financial system. And the corporations, the systemically solvent corporations, will ensure also in the future that we can take on all the capital intensive economic activities that we need to solve all the challenges of the 21st century. And this is where we come to the end. And I started with talking about prosperity. And I think it's also apt to end here because in the end, this is what it is all about. And when I think about prosperity, I don't think about having more consumer goods or faster cars. It really means to create the capabilities to deal with the issues that are really important to us, to build a better society, to protect the environment, to really solve and address the important challenges of the 21st century. And for this, we need more prosperity. We need more economic power. And we cannot get this economic power with this outdated and flawed and dysfunctional economic order that we see today. So please help me in bringing these changes that we need to build a better economic order. Thanks a lot for your attention.
Thank you very much for this fascinating and insightful talk. It was very inspiring to hear you. I think everyone here is very happy that they participated in this lecture. So who are you? What can you say about this? You are the anonymous banker behind this book and behind this presentation. Why are you not just putting all your time into doing banking business instead and earning huge amounts of money? What are motivating you to writing this book and visiting us here today?
I was fascinated, or still fascinated, by money, and never really, maybe to this day, still don't understand it fully. And that's why I also went into banking and finance, because it's really intrinsically interesting and motivating, and working in a global bank really allows me to kind of understand better what is going on. And I think that is the position to take to write books about topics, right? that you try to master a topic, to understand as much about it as possible. And I think that, yeah, it's only possible if you invest your thousands of hours, and then the best way is to work in the
Mm.
field. Yeah.
Yeah. Thank you. What have you learned from your time as a banker then? Have you learned something that has been especially useful and motivating for you to write these books?
I mean, there are many things. I think it really helped us for the first book to understand the regulatory framework. We described shadow banking in a very detailed way. Um, and it was also interesting to learn about this kind of macroeconomic implications, um, yeah, of how this banking and this money creation really impacts every life of everyone in our society, right?
Mm.
But it's a convoluted impact. Um, and that kind of also makes it difficult to really get the attention that it deserves, given the importance for our society.
Mm. Yeah. How have this reform proposal, how has it been received by people then in the corporate banking sector, and that maybe you have discussed your ideas with other bankers as well?
I discussed them quite a bit, and it's interesting that people working in finance and banking, they're quite open to those ideas. I mean, on a, let's say, intellectual, conceptual level, right? Because they see it firsthand, and many or most of them see the flaws of the current system. There's kind of widespread, let's say, awareness that the system is really going quite wrong, and in a quite astonishing speed at the moment. So they're usually the people who are very open to it, to
Hmm.
discuss it.
Yeah, that's interesting. Um, the concept of capitalism, money and banking, it can be quite difficult to understand for ordinary people. So maybe we should just try to make a super short summary here of the main points then. So first you had capitalism and the definition of capitalism and its connection to banking. If you should just use a three-sentence summary or something like this, so people can go from this webinar and tell their friends about this, what would you say then?
Yeah, capitalism is not about markets. It is about corporations. And that's really central. And it's so obvious, right? But yeah, no one else kind of made this definition. And I'm absolutely convinced it's the
Yeah.
only meaningful definition of capitalism. The second point is capitalism, the corporations, they manage all the capital in our society. And that means they also manage our money. They create all the money, they distribute all the money, and they do it in a way that really is very flawed. It's unfair on the one side, but I also think it's very inefficient. It really suppresses economic prosperity. It makes us all poorer the way corporates manage our money today. But corporations are a very human product, so they're very. This is completely to us how we design corporations. Um, and the fact that they are like they are today doesn't mean they cannot be changed. We can
Hmm.
change capitalism.
Yeah, this is a hopeful message for us. Yeah. And the bad sides of capitalism then. So what are the top three worst sides of it that you would mention?
Well, the problem is really this boom bust and financial crisis cycle. That's really at the core, because then it requires all this intervention. It squeezes out the market economy, and then you add technology to it, and it completely spirals out of control. This is what we have been seeing for the last 200 and 300 years, right? It's a very, very consistent story. Um, but the impact, I mean, a lot of people talk about stability. I don't think it's unstable, because especially since we have fiat money, I mean, we're living in a unconditional fiat monetary intervention system. So those liabilities will always be guaranteed, right? It's not like the big problem is not like those up and downs. I think really the big problem number one is that, yeah, it will no longer give us prosperity. We will get poor if we stick to this economic order. And the second thing, it's also deeply unfair. we will not be able to sustain an open society if we stick to this economic order. So it will make us less free and it will make us poorer. And that's a terrible thing to do for an economic order.
Yeah, it is what you call the financialization of the society. And the
Yeah.
financial sector is squeezing out the real economy, or formulate it in this way.
Yes.
Yeah. So then your proposal, how to reform capitalism. So here I will just try to give my brief summary of it. So we have these two sectors you talked about. I mean, the banking sector in a broad way that includes the shadow banks, etc. That can be seen as the money creators in the economy, and then we have ordinary corporations that don't create money today. And you have your systemic solvency rule, and we have not gone into the detail, but the rule is putting this super clear boundary around that separates these two sectors in a very stringent way. So this can be seen then as the first part, and then the second part is to squeeze out these money creators from the economy, and do this through regulation that is actually just fair regulation. It's not any, I mean, targeted regulation that are supposed to, I mean, punish them in a special way. So this is the thing I really like about your proposal. I mean, if banks or politicians, if they object and come and say, oh, banks, this is the shit, we really need banks. They are doing God's work, these companies. They really contribute with value to our economy. Then you can answer them by, oh, okay, prove it then. We don't forbid your business model. We're just creating an equal playing field here for everyone, and you will just compete on equal terms with all other corporations in the economy. And if you're right, I mean, then banks will survive fair regulation, no problem. So this seems nice to me. But you seems to have then a very clear hypothesis here about who will become the winner then in the end of the day. So here is a picture just to try to illustrate it. So here we have the banks, and here we have the real corporations in the real economy. So you seems to argue that in banking, this is an old and inefficient technology. It's like this horse and cart industry, and we don't need it anymore, because there exist new and better ways of doing payments and of providing loans. And you mentioned them, for instance, P2P banks and other fintech solutions. So, and then, of course, the questions arise. So, okay, why are not banks outcompeted yet? If banks are this old technology, so. But the problem has been that politicians, they have just continued to keep them alive through artificial breathing, state subsidies, guarantees, special tax programs, etc., etc. And I think this is somewhat absurd. It can be compared with, I mean, continuing to insist that everyone should drive with horse and carts. This is the thing. So and then doing everything you can do to make this industry to survive, in spite of the fact that there is much better innovations today. It's cars that can be used. So, yeah, your proposal, it's setting an equal playing field then for everyone through tightening the rules. So banks are charged for all extra benefits of public money creation. And then your hypothesis is that banks will naturally be outcompeted. So, yeah, maybe you want to comment something on this. Have I understood you correctly?
You nailed it. You nailed it. And I mean, there are two parts to why we are going this way. The first part is really, or maybe three parts. I think three parts. The first part is really convincing people, let's say, outside the monetary reform space. And we always got this argument about that basically the market should decide, right? And that also led to us really thinking about, yeah, what does that mean? Where is the market? Where is capitalism? And I think for so many people, it's still so embedded. So we tell the people, look, then let's put up a fair game. Let's see what happens if we really have a fair and level playing field. And as you said, I'm absolutely convinced in a fair and level playing field, the banks will disappear, right? And the whole money creation, the shadow banks, it's so inefficient, especially when you think about shadow bank in particular, where the main motivation is to complicate the business model to kind of disguise it from the regulators. So that's the number one. It's really the attractiveness of the proposal. Number two is also the transition. And I think there, that was also the weakness of our first book. We didn't offer any transition, but one thing is really to paint the vision. What kind of economic order do we want? But then on the other side, you have to find or propose a path how we can get there. And the other option would really be just, yeah, we implement systemic solvency, and after a certain amount of time, we just liquidate every corporation that is not systemically solvent, or analogously for other, let's say, monetary reform proposal, they would overnight switch entire liabilities into assets or kind of convert inside money into outside money. That would be a huge shock to the system without any precedence, and no one would know what would happen. But when we do it that way, where we really put in an effective regulatory framework, which we anyway want, right? We anyway want to have an effective regulatory framework around banking. And then we can finally slowly and gradually squeeze the life out of it, and really kind of make way for those new ways of doing finance, peer-to-peer lending, new kind of potentially cryptocurrency, blockchain. I don't know. We are very agnostic about what financial technology will ultimately make it. This provides a transition that is really realistic and feasible, and kind of improves the situation along every step of the way. So that's the second thing, credible transition. The third thing is really, and maybe you're surprised, I didn't really talk about money for the entire. I mean, we did talk a bit about money creation and everything, but monetary reform proposal is then a distinct step. So let's say you want to have unconditional income to inject new money, or you favor quantitative easing, like, yeah, the government should spend money to help kind of fighting climate change, or that is a separate question to systemic solvency and the implementation of it. And this is really important, I think, for people to understand. Meaningful monetary reform requires first a reform of capitalism. As long as we have this form of capitalism where corporations are out of control, then no matter what monetary reform we put into place will be meaningless, because always the financial stability will take absolute dominance over all other monetary policy objectives.
And this is a question I think we will also discuss more in the last part of this webinar, because I think people may have different opinions here also. But I just wanted to just summarize a final summary, and then questions from the audience, or maybe you want to comment something more before that. So just what this proposal achieves then. So it's the systemic solvency rule plus fair regulation plus market competition. This seems to then stop banks from creating money, as we in the monetary reform movement want to do. And it also seems to have the good property that it not prohibits local currencies and stuff like that. And some people think this is a good thing. Other wants to forbid everything but state money. So this can be seen as just the first part. But in the book, you have this also proposal about public money creation, because I mean, if you stop banks from creating money, I think it's also you need another channel for creating new money. How? And this is discussed in the last chapter of your book. And we have not said very much about this yet. But your proposal here then was a public monetary authority that creates new public money free of debt and issue it directly to the citizens. And also a constant liquidity fee. If you need to shrink the money supply, you have this constant liquidity fee. This means if you stop issuing new money to the citizens through this channel, the money supply will shrink. So maybe you want to say something more about this second thing, because we have mostly been talking about the first point now.
Yes, and I'm for us, this is really what we would prefer, right? And there are a couple of reasons. I mean, one is really the egalitarian setup. We think, especially for the Eurozone, it's particularly attractive, right? Every citizen of Europe getting this money into her or his hand and being able to spend it any way deemed fit. Um, it's kind of a very egalitarian thing. And on a second aspect, it's like from a monetary policy perspective, it's extremely effective. So any changes to your kind of instruments, like the change in the amount of money that is distributed, will have an immediate impact on things like price stability or economic activity. So it will be very, very powerful tool. Also note, like the financial stability argument will no longer apply. We don't have those endogenous and system-induced boom-bust crises, right? So I think for monetary policy, it would be even better to completely step out of financial markets because, yeah, we will then be in a world where those financial markets actually work and help balance the economy. And lastly, also from a government perspective, this is a monetary policy that would completely separate fiscal and monetary policy. And again, for the Eurozone, it would be particularly attractive because this would really set the possibility that the solvency of governments will no longer be linked to the integrity of the European Union and the Eurozone, right? Because once this link is broken between government debt and financial stability, which it will with systemic solvency, then we can completely separate monetary and fiscal policy, which is a preference from my perspective. But I understand there are also different political opinions on that. So that's why it's really important for me to reiterate systemic solvency is the fundament. And it's much more important to us to get capitalism right. And then we think monetary policy is also important, but it is not as important as this fundamental system question, or this even more fundamental system question.
Okay, thank you very much for this. Now we will continue with the questions from the audience. And
a question from Stina Kilander. Besides the market-based financial architecture that you propose, you also propose a new monetary policy design that is only briefly described. Does the new financial architecture require this new monetary policy?
It will require a new monetary policy, but I think we offer options, right? What would be feasible? So we kind of propose we could stick to traditional monetary policy, like really going back to how the Bank of England conducted monetary policy, basically financing the government. We could do really these new forms that we discussed, like this unconditional income. We could go to some sort of cryptocurrency as an underlying kind of, that would be more a libertarian view, like where basically from institutional perspective, control would be given up, similarly to how we had a gold standard. What we cannot do is to go back to this policy with interest rates and transmission mechanism that is still conducted today. I think already today is very ineffective, but in our new economic order that we are envisioning, this whole kind of setting a reference interest rate, that of course would no longer work. So the answer in short is, yeah, we need a new monetary policy. We make our preference clear there, but it's not the only option to go.
Okay, thanks. Next question is from Thomas Morgenroth. Do you expect that positive helicopter money supplied to citizens will gradually replace the credit-based money circulated by private banks?
Yes, correct.
Cool. Very short and clear answer. Okay, then we move on to the questions from the Q&A session. And we start with the questions with the most votes. I think Peter asked, how do you prevent that a growth-based economy blows the natural system to pieces?
It's a very good question, a very, very important question. And I also thought, or I'm thinking about that a lot. And I also thought kind of today and yesterday how to answer that. And at the moment, in the current economic order, I mean, there's really this dominance of financial stability and basically also social stability. So any kind of growth is basically requested by the system, no matter how kind of damaging it is to the society or to the environment. I mean, I have some personal opinions here. For example, what happens in the technology sector, like those kind of social media products or technology products that really kind of seems to make our lives worse off and kind of monetize our intention, but really seems kind of to have very destructive social implications. Yet the share price of these big tech companies are systemically relevant, right? We need to pump them up. We need to make sure they create more revenues and make the richest people even richer, just kind of to maintain this financial stability and this financial core that it is not kind of collapsing and turning into this bust and into this financial crisis. So this current economic order forces us on growth just for growth's sake. And that can be very destructive. And I think we see that more and more. And it's not only technology, it's also, when it's about our health, when it's about our environment, where we really see like, new products, new services that really seem to be a double-edged sword or really not really a good thing for us. But if we could finally be freed of this boom bust cycle, of this constant fear of economic and social collapse, and we would have a truly stable economic system and also a financial system that is fully transparent. I mean, imagine if we have a fully systemically solvent financial system. If you live in such a system, you don't have money on your bank account anymore. Either you have outside money or your money is invested. And all the money that you have invested, it will be fully 100% transparent to you in which industry, where in the real economy this resource is deployed right now. And I'm convinced most of us would really have a lot of non-financial preferences to kind of decide what kind of projects in the real economy, what kind of enterprises am I willing to support, and what kind of enterprises, what kind of businesses I would never have my money, my resource, my hard-earned wealth to be deployed into. And I really think that will, so those two effects, this inherent stability and this lack of fear from collapse, and on the other side is full transparency, will lead to an economic growth that is genuine, that really brings products and services and also progress for a society that we actually want and where we really kind of can improve our lives and our interaction with society and the environment.
Thanks. The next question is from Jonas. If you squeeze out the financial system, will that mean degrowth?
And I think that kind of is really linked to the other answer I gave, right? I mean, we don't want to squeeze out the financial system. We really want to create a financial system that is really powerful, that really signals to all of us where is the money going, where are the resources allocated, what is done in the real economy with the labor, with the energy, and it shouldn't be that bloated. It should really be lean and efficient. I mean, when you imagine all those people working in finance, they're like highly educated, creative, sometimes innovative. And I mean, all their talent is wasted in creating yet other financial kind of complicated structures to circumvent regulations. I mean, imagine only this human power deployed in the real economy for really productive purposes. So, no, it's not about degrowth. It's really about prosperity. It's really about prosperity for us, prosperity for society, and prosperity for the environment.
Thanks. Then once again, Jonas, I'm surprised you haven't talked anything about all-purpose money and the dependency that money have with regards to energy and resources. Can you say something about that?
So in the end, I think, and that's kind of a big flaw in the bankers' thinking. That's what bankers think. Bankers think paper builds railroads, or paper builds factories, or they really think, I think someone mentioned it, this God's work, right? They really think it's money that builds all these things, right? And that's inherently wrong. It is really, on the one side, human imagination, but on the other side, it's real labor, it's real energy, it's real resource, it's concrete, it's fuel, it's power, and it's human labor combined with human imagination that creates wealth. That's the only kind of material wealth that we can create, is with those kind of inputs. And the role of money and credit, in the end, it's just an information device, right? It should basically help us to get the best out of our resources, of our hard work, of our imagination. And that's what we should measure a financial system against. How good is it to turn our imagination and our resources and our energy into genuine prosperity?
Okay, then we have Linda.
Yes, we will continue with the questions and answers. I just wanted to say that the time is past the announce ending time, so I will just very short say thank you to everyone that has participated this evening. And if you want to help us to organize more events like this and campaigns, etc., around this, so feel free to donate to International Movement for Monetary Reform. I have sent you the link in the chat. We are doing all this work just at our spare time for free. So yeah, every help is appreciated, and feel also free to engage in this movement. You can be part of it. So welcome to work together with us. And now we will continue the QA session. Kirill.
Sure, let me open a question from Linda Lutman. Why isn't the system of capitalism trickle down as it should? The economic gaps between people are huge. There is poverty on earth that is catastrophic. This worries me a lot.
Yes, I agree. And I think there are many factors to it. And one factor definitely is the way the financial system operates. I mean, we have talked about overall prosperity, and I mean, the curve I've shown is an average, right? It wouldn't show the distribution of it. But I also think the whole way, basically this corporate banking works these days is fueling a lot of this inequality and this unfair distribution. And there are many channels to it. I mean, one is definitely like this explosion of real asset prices, that really concentrates wealth. Then also this bloated financial sector that kind of skims money and wealth from all sectors of the economy. But of course, there are also other factors that may not be directly related to kind of this aspect of capitalism I've been talking about. So, yeah, I mean, political institutions, kind of political power imbalances on a global stage. I mean, all these things play a role as well, right?
Okay, thanks. Then we have Christopher Sjolund. Could creation of money be something that only a state-run central bank would be allowed to do? For example, with some kind of blockchain or so to mark every coin. What could be the effect on the society with such a change?
Like blockchain-based monetary policy.
I think the focus is on state-run central bank.
Okay, it's like central bank outside money.
Yeah, I think so. Yes, that's the question.
So, I mean, the reason why we went to inside money in the first place, I think the main motivation was really this alchemy argument, right? We had very scarce gold and silver, and that kind of forced us a bit to come up with ways to multiply on those kind of scarce base metal. And we see today that this is no longer required. That's kind of the one main argument that we have inside money, that we kind of have this money creation. Second argument is this whole kind of banking doing God's work argument, that this kind of that only banks are able to create enough money and lend money so that it can fuel economic growth. And as I said during the presentation, I think that may have been true until the middle of the 20th century, but with new information technology, I think this argument really falls apart. There is no longer a reason why banking should be the only way to channel kind of this credit into the real economy. We can do it in other ways. So, I mean, how it changes is then really, I guess, the question, what kind of monetary policy we enact, right? And how much kind of central coordination or how much central steering we kind of impose on the system. So it's also a bit a political question. If we do it the way that we are proposing with unconditional income, I think then, yeah, it's a really very, very market-based financial architecture. If the central bank still takes a very kind of activist role and really channel credit towards other political targets like climate change or other social goals, then it would still be yeah, more kind of, let's say, steered financial system.
Okay, then we have a question from Alenka from Slovenia, which is very closely related to the previous one, how CBDC fits into this systemic solvency model.
Yeah, and I think, yeah, we're talking about very similar things here. And it's interesting, CBDC is, and what is even more interesting is we're talking people kind of from the CBD space, but we also talk about people like Anna Tatmati, who's more in the banking regulation space, right? And kind of those people who advocate higher capital requirements and kind of put better controls around banking. They kind of seem to say very often, our CBDC will not solve anything, right? Because banking is still out of control, and now you put CBDC in, but when there's a crisis, people would still, or governments and central banks would still be forced to bail banks out. So even if you have like this safe money alternative, um, yeah, that wouldn't kind of help it, right? And the CBDC people say like, yeah, let's forget about banking. Let's just create something new, and people will kind of go to this new thing, and then we will no longer have to care about banking. And we're really standing in the middle when we implement systemic solvency, like in the transition. Then we will have two financial sectors. We will have the systemically solvent financial sector, and we will have the systemically insolvent financial sector. And you can think about it at the financially solvent, the systemically solvent financial sector will behave. It's a CBDC world. Think about it as a CBDC world where the central bank issues CBDC, and all those financial institutions, they just kind of intermediate and channel this CBDC. They don't create additional money on top of it. And the systemically insolvent sector, that will be you could call it the Atmati world, like a really very densely, very tightly regulated banking system that can no longer spiral out of control. So CBDC is just part of the answer. And that's really important to understand. If you implement CBDC without systemic solvency, I don't think you really change the critical thing.
So maybe I can jump in here also, because we have a longer question here for the more advanced part, and I can screen share it here.
so you all can follow it, and I can try to explain it briefly. So this is an objection, and it's based on Hockett and Omarova's arguments, and they have written several articles and I also think books about this. But their argument then is, I mean, suppose that we build a really strong public payment system through a CBDC for all or something like this. So suppose that the state, it is paying taxes and it's paying public salaries, etc., with this public money that everyone can use. And suppose that this makes the CBDC into the most widely used means of payment. So almost everyone will use this means of payment in the society. Then I mean, the payment system now, it seems to be perfectly safe. So what happens to the banks, it doesn't matter. At least not from the perspective of the payment system. But then there may, of course, still be one risk. If bank goes bankrupt, etc., and the financial sector get problems, etc., then access to funding may disappear, and the economy may now suffer from a shortage of money or inefficient allocation of the existing money, etc. These kind of problems may appear. But then Hockett and Omarova, so they argue if the state take a very active responsibility here, and if they have a state investment bank and maybe other channels also for issuing new money, then there is no risk of shortage of money. So if banks and the financial companies, etc., if they go bankrupt, it's not a problem because, yeah, we have the safe payment system. Everyone can pay each other, no problem there. And we have a system also for distributing new money to the sectors that need new money, loans, etc. So in case of the private market fails. So in this context, then it seems to make sense for the state to promise, okay, we will never more rescue banks. No more state guarantees and subsidies towards the banks. So Umarova, for instance, then she argues in her paper then that, I mean, the MMFs, monetary market funds, commercial papers, repos, derivatives, etc., all of these kinds of financial products, they will shrink in usage. And this is just due to the discipline of the market. The discipline of the market, it is enough to substantially shrink down these sectors. So they would then argue that, okay, your systemic solvency rule, it's actually not needed. This will be enough. Why then prohibit maturity transformation? You don't need to prohibit it because the discipline of the market will ensure that this business model, it will not go bananas and create systemic risk and stuff like that. So just to explain their arguments.
Yeah, and thanks for presenting the entire argument, because I think there are a lot of issues in this argument, and I would really like to list them out, because it's really important. And I think the one part already entails it in this long question. Sorry, it's not only about the payment system, right? I think that's clear. And we talked about this boom, bust, and financial crisis, right? The main primary motivation behind bailing out and protecting and guaranteeing bank corporations or banking corporations or shadow banks has never been the payment system. It has always been the economic cycle. It's always been the problem that if money and credit evaporates and you have this bust, and this bust escalates into a financial crisis, it's really the real economy that suffers. So safeguarding the payment system will not save you. It's nothing. It's nowhere sufficient to guarantee the economic order, if you just safeguard the payment system. That's point number one. Then point number two is really the concept of market discipline. And I think theoretically you can make the argument, and theoretically it has been done by dozens or hundreds of people over the past 3 centuries. We have seen it basically in the 19th century in England with the Bank Charter Act, where they even implemented kind of strict rules on how much money the Bank of England is allowed to create. We have seen it even in the foundation of the Eurozone, where the ECB was explicitly prohibited from kind of monetary debt financing. and from bailing out basically governments or member states. We have seen it at the eve of 2008, where basically the US government and the US regulators explicitly said on all the disclosures they would never guarantee money market funds because they are part of the market. They always said, like, this is on your own risk. There's market discipline. If you park your money in money market mutual funds, will not be there to save you. There were also caps on the deposit insurance. There have been so many pre-commitments in the history of capitalism to not bail out, to abstain, to let market discipline, and this is also the exact terms they often used, or that is often used. And none of these commitments have been honored. Always it was bailout, always it was guaranteeing the liabilities, no matter what was committed or promised ex ante. So theoretically, yes, maybe this is the first time where market discipline works, but based on historical experience, and it's absolutely overwhelming and it's absolutely uniform, if the financial bust turns into a crisis, the government and society will bail out no matter what was promised upfront. So that's to the market discipline. Then the third point is really the transition. You need to think about the transition. How do you really kind of bring society and economic order to move from this current economic order to the next one? And of course, building up this alternative way with CBDC is just one step, but you need to do something with the old system. You can't just kind of let it be left to its own devices. So I don't really see how a transition would work with CBDC. Because at some point you have to phase out those bailouts officially. You would have to say, at this point, deposit insurance no longer applies. At this point, corporate banks no longer have access to the let's say emergency liquidity facilities of the central bank, etc. And I've never seen a proposal that would really give me a convincing plan how that transition could work. So that's point number 3. And point number 4 is also long run stability. Now imagine you would kind of solve these 2 issues of market discipline and transition, and then 30, 40, 50 years pass. I mean, people will forget about all these problems with boom, bust, and then someone would come up with a new scheme, and this scheme could run for years, kind of generating very high returns for those who are participate, and it could become really big again. And then if it becomes big enough, then if it fails, the government again will come to the rescue and bail it out. So I don't see how it could be stable in the long run. And people forget very quickly, right? I mean, after 10, 15 years, they may start investing in those schemes again. These so-called risk-free, interest-paying money deposit schemes, and if it becomes big enough, it will be bailed out again. So that's kind of those 4 points. So yeah, number 1, payment system alone is not sufficient. Number 2, market discipline has never worked. Number 3, how do you transition from one to the other? And number 4, long run stability. Those are the 4 arguments I would put against that.
Yeah. I think that Umarova Hockett would answer then that, yeah, market discipline, it does not work today because there is no market. But in the context of if you first establish this public and safe payment system, so you need this in place, and you also need a public way of funneling new money into the economy, like your public investment bank or stuff like that. It's only in the context of that it's possible to make this promise to not rescue banks anymore, because without it we are totally dependent. I mean, today we are dependent on the banks to even be able to make digital payments at all. We are fully in the hands of. We have to rescue them for this purpose, and we also have to rescue them to be able to fund companies and do things and get access to money in the economy. So the consequences would be really bad if we don't rescue them today. But in the context of these new proposals they have done, it will then be possible to not rescue them anymore. It will not be harmful. So that's I think what they would say. And the other way to do things here, I mean, it may be quite similar to your proposal, but you could introduce a CBDC first and introduce it, I mean, slowly, and you could also introduce regulation in the kind of way you propose to I mean, squeeze out the banking sector. And so there may be different ways of combining proposals here and doing it in different orders. That's just
absolutely. And
yeah.
the argument is not those 4 points speak against CBDC. It's just to say if we just introduce CBDC and do nothing else, it will not free us from bailing out the corporate banking sector. And you said like this safe payment system, that's not enough, right? It is not enough to just provide a safe payment system. The crux, the core issue is the boom bust cycle, right? And you can't address that with CBDC alone. So introducing CBDC is a good idea, but it will not solve the issues in itself. And as you say, I think this systemic solvency rule will create an entire financial sector that will run on CBDC. I think that would be the likely outcome or the clear outcome of it.
I can also mention one last argument there from Omar. I think it is that and it's also an argument in your book of the end of banking, the first book, that the public guarantees and subsidies towards the bank. I mean, the bank move assets from their balance sheet into the other balance sheets, into the shadow banking sector. So this means that the guarantees that we have towards the bank will also indirectly go to the shadow banks through this, the linkage of balance sheet between all these organizations. So this means that, I mean, and that's what Umarov argued, then, that if you don't have to guarantee the bank's balance sheets, then all these indirect guarantees towards all these other kinds of financial entities, etc., will disappear.
But if you think of it the other way around, at some point when you then really, let's say, credibly and effectively revoke those guarantees, at some point in transition, you have to do that, right? You have to say, like, this is now the point of no return. Now all the guarantees are revoked. Then, I mean, everything in the old corporate banking sector, because everything is so closely connected and so intertwined, would come crash down all at once, like all the shadow banks and all the banks. I mean, if one of them is pushed into insolvency, it would lead to the fall of all of them all at once, right? So basically, this argument that basically the bank guarantees are implicitly moved forward to the shadow banks, and that means if we can remove it from the banks, we can also remove it from the shadow banks. Also means if we remove it from the banks, it will trigger kind of the collapse of the banking and the shadow banking sector all at the same time, right? And yeah, I don't think it's credible, right? I mean, in this highly interconnected world with digitized bank runs and like huge piles of financial derivatives, this huge interconnectedness between all those balance sheets, I mean, that would take minutes or hours to have a financial storm of unprecedented dimensions, right? And I cannot imagine any government having the guts to see this storm through without intervening.
I will not continue this discussion now because there are so many other questions.
Okay.
And also, Thomas Morgenroth from the Reading Circle, you had a couple of questions also before. Maybe we should let you ask something live here also. You have raised your hand for a long time.
Yes, I actually have kind of different questions now after all these things that have been said. Maybe I can put them first. Mr. McMillan, you made this interesting statement, moving statement, that such a lot of human energy and power is really being wasted in the so-called financial industry, of people developing more and more complicated financial products, so-called, in order to circumvent the regulations. I mean, this is kind of a competition between regulatory staff and investment banking staff. And this competition obviously seems very motivating and in the end very profitable. So I don't quite see yet how you want to demotivate in an evolutionary way the investment banking people to refrain from doing their work. Or do you feel this should all just be forbidden by government or something like that? Because the regulatory strains are obviously never able to really prevent the system from flourishing, I think, because they are usually also the lesser paid personnel in the regulatory instances than those in the investment banking business itself. Can you say anything to that?
Yeah, I mean, there are a lot of aspects to your questions. So I tried to kind of find kind of a line to answer it. I mean, the way kind of profit opportunities emerge in the current system, they have always a lot of to do with regulation, right? And I think what really is the core to understand what profit opportunities are is really this huge leverage, and it's really kind of when we talk about effective leverage, we talk about, I don't know, a leverage, let's say of 50, right? That's kind of what I would think about realistic. So that means banking corporation hires an investment banker or a financial professional, and kind of tells this financial professional like, oh, this is $2 of the equity of our shareholders, because we have a government guarantee and we can count on the bailout. We can easily borrow 98 additional dollars or euros on those $2 we put in as equity as skin in the game, right? And then the whole game for the financial profession comes to invest those 100 kind of dollars or euros in a way. It's kind of the traders will call it picking up nickels in front of a steamroller, right? If you deploy those 100 and for example, you generate carry, that's the very traditional banking business. You borrow overnight, hopefully at lower rates. I mean, at the moment it's a bit different, but traditionally you would borrow overnight at lower rates. And then you would invest it into some kind of 10-year or 15-year or 20-year assets or bonds or whatever. You have a carry between what you invest to and how you borrow, so you make maybe 1% more, but then you multiply it by the leverage, right? And then your profits become spectacular. Let's say you have your 100, or you borrow your $98 at 1%, you pay like less than $1 interest, and then you invest your $100 at 2%. Then you make $2 out of it, right? You could say, oh, from 100 to $102, it's not a lot, but you do it on your equity. So you doubled your equity effectively, right? Or you increase it by 50% because your equity was $2 before, and now it's $3. And what it effectively then translates into is during the boom, it's really private profit taking, right? During this kind of, in this scheme with high leverage, with government subsidized financing. And then at sometimes the boom turns into a bust and into a crisis, and then the losses can be offloaded to the taxpayer. And this is how this kind of, and of course during the boom, everyone looks very sophisticated and clever, right? Because wow, he had a trading book, or she had a trading book, and she made 50 million for the corporation in 1 year. It's amazing, but of course it was the boom. Everyone kind of being able to borrow overnight and invest it in a 10-year security would
excuse me, sir, may I interrupt you? I'm not sure whether I could make myself understood concerning the question. I was actually asking, how do you want to get rid of this system? Not how the system works. How do you want to get rid of the system in an evolutionary way, or do you see the only way of governmental intervening, completely cutting off investment banking, for instance? Because I think the system as such has so much internal driving force, it will not just subside.
Yes, and then
What's the question? Is there an evolutionary way you propose to get rid of this dangerous system of financial product world, so to say?
yes, I mean the most obvious one is then the leverage, right? Let's say you bring capital requirements to a level of 20, 30, 40%, right? Then, and this is kind of all the schemes rely on leverage. And like before deposit insurance was introduced and the interventions weren't that heavy in the 19th century, I mean, average banks had a capital ratio of 30, 40%. And they also didn't do much maturity transformation, right? Because that was hazardous. I mean, that was Adam Smith with his real bills doctrine. Like the example I gave in the presentation, that was like the main banking business, like trade commerce, right? You buy goods and you need to bridge liquidity until you sell it. So if we bring banking to that level where we have like 30 to 40% equity, where we have limited maturity transformation, then all those profit opportunities disappear. So it's very clear that's the way. It's the leverage. You cannot allow this leverage of 50 or even more. You have to bring reasonable numbers back. And I think reasonable numbers are 20, 30, 40%. And then banking becomes a very boring business again, right? There will not be like these extreme profit opportunities, especially not if they also have to compete with more sophisticated with financial systemically solvent financial corporation using more sophisticated financial techniques. Politically, I mean, I see your point, right? And this is not my strong point, how to kind of, on a political side, because they benefit a lot from the current system, so they will fight such a change tooth and nail for sure.
I muted you, Thomas, because there are so many other questions. So, Kirill, maybe you want to continue with the list, but the clock is also more than 21. So, 9
maybe
o'clock.
one last question.
It depends on you, Macmillan, also. If you're tired.
Let's do one more question, yeah, and then I think
okay.
we're more than 2 hours in. Yeah.
Yeah.
It's a question by Emma. I think it's everybody is interested in the answer. When do you expect the next financial crisis? Do you believe it will need a financial crisis to change the rules of the financial system?
Look, I don't know. I mean, this is impossible to answer up front when the financial crisis will hit and how it will look like. I was surprised that kind of I mean, last year it looked like it unraveled, but I mean the intervention was very, very fast and very, very complete. So I really don't know. I mean, it's just when you look historically back, and I think the one kind of, when you look at these larger time horizons, it's kind of irrelevant, right? I mean, we know it will happen again because we have now 300 years of experience with that system. So, that's just a matter of time.
Okay. Thank you, everyone, for staying 40 minutes more. It's 80 people left here in the webinar. That's amazing. And thank you so much, Jonathan McMillan, for doing this and visiting us at this webinar and answering all questions in this good way. We're very thankful for this. And
and thanks a lot. And it was very engaging. And I'm really, really glad for all the interest. And if there are any follow-up questions, maybe some of you can, if I have time, I can look into that. But I really hope, we can engage again.
If you still have questions, you can email them to me, and I can try to find the best of them and send to you.
Yeah, sure.
And you can, if you have time, you can answer And we can send in an email to everyone also. Yeah, that's a possibility. So let's end for tonight then. Bye bye everyone.